Janet Yellen says you don't have a recession when unemployment is so low. And that is just plain wrong. If you look at history, look at all of the recessions back into the 1960s, and the unemployment rate was at its absolute lowest immediately before the recession started. So the fact that we've had low unemployment does not in any way preclude a recession coming very soon.
This is Kaiser Johnson, and here's the weekly special for November 13th through 20th, 2023, while supplies last. XF $20 Gold Liberties at $1.65 over melt, and 2023 Silver Philharmonics at $3.40 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today are two of our favorite guests here, Adrian Day of Adrian Day Asset Management, and also Lobo Tiggre from the Independent Speculator. Adrian and Lobo, thank you so much for joining us today.
Thank you for having us.
Happy to be here.
Well, it's great to have you both. I did want to ask Adrian first, your perspective on what the Fed has been doing recently. Obviously, they've raised interest rates substantially over the last couple of years, and we've had you on the show before. You've mentioned that the effect of the rate hikes have not been fully felt by the economy. And even if the Fed keeps interest rates high, there's a lot of damage to be done. Your perspective on where they are right now, and also, do you expect them easing next year?
Yeah, lots of good questions there. I think, first of all, it's very important to recognize that monetary policy, as we know, works with long lags, long and variable lags. But the average, if you look at the interest rate hiking cycles back to the 1950s, you see that there's an average of 22 months after the hiking cycle starts before the onset of a recession. That's the average. And we're not yet at 22 months. We're close, but we're not there yet. So people who think that because we're not in a recession yet, therefore we've got a soft landing, we've escaped a recession, I think that's a false. I think that's false, and they're not looking at history. If anything, this time, I'm not going to say this time is different. This time could be one of the longer lags, and the reason for that is we've had, a long period, 12 years of excessively easy monetary policy, and then a long period of ultra low interest rates, which enabled households and corporations, not the US government, however, but households and corporations to refinance, to bring down their interest payments, and to extend the maturities. And so going into this rate hiking cycle, balance sheets of corporations and many households, not the lower level, but the lower 50 percentile in terms of net worth, but certainly the upper 50 percentile, were better than they were going into previous rate hiking cycles, which again means that those lags before the recession could be extended. But and I'll stop here. But I think a recession is as inevitable as anything can be. It's already, the recession is a result of the hiking we've already had, and it's going to be very difficult to prevent that happening. I'll let Lobo jump in.
Yeah, I agree with everything Adrian just said, but I guess the numbers I had seen suggested that the median was 18 months. So I was a little bit early on saying, we should see more signs of trouble by now. But you know what? It's starting to happen. We just had retail sales today go negative, and okay, it's just 1 month, but still, we've had this strong labor market, and we're starting to see the unemployment rate go up. It's up 0.5%, that's a lot of people since the bottom. So I think this is particularly important because I think I've used this analogy before with you, Elijah, that the U.S. economy is perched on a one-legged stool. It's this worker consumer. The labor market's still strong, so the worker's still spending in the stores. And the latest data, granted, this is short data. It's not a long trend yet, but it's starting to suggest that that's breaking, that that's starting to cave finally. So, I thought that we'd probably see more signs of trouble by now. I famously or infamously said I thought that the recession denial would give way by the end of this year. I only have a month and a half left to be right, but that could happen with what has already started. But if not, it doesn't matter. I agree 100% with Adrian. I think it's baked in the cake. Nothing is certain in the world of investing, and certainly not speculation. But this is as close as it gets. And it's very bullish for monetary metals, safe haven assets that we all know and love, Liberty and Finance. Well, one more thing, though. It just blows my mind to see not just, random people on Twitter, but serious financial professionals on Bloomberg and on, mainstream media talking about, well, gee, it's been already almost 2 years and there's still no recession. All those recession bears were wrong. It's happy days, and making cases for risk assets, not just the economy or the markets in general, but for risk assets to be a great bargain now and headed, ever higher in the year ahead. And it just, I understand, I guess, if you're talking your book, you're paid to say certain things. Maybe you have to, maybe that's the explanation. But it just strikes me as gobsmacking that financial professionals all over Wall Street are just completely ignoring the facts. And, they'll even say, oh, long and variable lags, but yeah, everything's fine. The non sequitur is really astounding.
Well, and I'll add something, if I may. I think you both know, and I hope your audience knows, I'm no apologist for the Federal Reserve, far from it. But, Jerome Powell, the Fed chairman, has emphasized the fact that monetary policy works with lags. And that's why he wants to have, that's what he says, why he's had a pause in hiking for the last few meetings. Because he himself says we have not yet seen the full effects of this. And to Lobo's point, if I may, about, serious professionals, I mean, Janet Yellen is a Treasury Secretary. Sorry, she's an easy target.
Said serious professionals, come on.
She's a Treasury Secretary and was the Federal Reserve Chairman. She is a labor economist. That's what her bio says, a labor economist. And yet Janet Yellen says, you don't have a recession when unemployment is so low. And that is just plain wrong. If you look at history, look at all of the recessions back into the 1960s, and the unemployment rate was at its absolute lowest immediately before the recession started. So the fact that we've had low unemployment does not in any way preclude a recession coming very soon.
If anything, it's a leading indicator. You look at that chart of what Adrian is just saying, and every time it just starts to curve up going into that gray bar of the recession. That's exactly where we are now. Doesn't prove that it has to go boom tomorrow, but that you just look at that chart. That is exactly where we are right now.
And if we can get both of your comments on what this means for commodities and precious metals. I know, Lobo, you said that really right now it seems like a fantastic environment for gold and possibly silver going into 2024. Your perspective on that?
Well, I'm going to put my Darth Silver mask back on here. I have to say I'm still concerned about silver underperforming, at least initially. And even diehard silver bugs will agree with me that silver always lags and then outperforms at the end, right? So even if you're bullish on gold going into 2024, that doesn't necessarily mean that we're bullish on silver. And I do think that, the data is very clear that silver's industrial side has come into play more and more over recent years. And that tells us that silver is likely to underperform even more this time. What's an open question to me is that, okay, silver always catches up in the end. Well, it did until 2020. So now that track record, a perfect track record, by the way, of silver catching up and delivering higher percent gains at the end of a bull market in monetary metals, that's no longer a perfect track record. Now, it's still like 9 out of 10 or something like that. So the odds are good. I'm still bullish. But I'm just saying, I wouldn't absolutely bet the farm or, give away the kids' college fund or something like that on a speculation that, going all in on just silver, for example. I think that's very myopic. There's no reason to not include a little bit of gold in there with your silver portfolio. A gold lining is not a bad thing. You're chuckling, Adrian. Did I say something wrong, or you agree?
No, I agree with everything you say, although I might sort of maybe change the emphasis a little bit or add a little bit. No, I agree with everything you said. And the additional thing is not only the change in demand, more industrial, but very significantly, there's been a significant change in the supply structure of silver over the last quarter century, let's say. And that is, and different from gold, whereas most gold is still primary production, the vast majority of silver is byproduct. And that's very significant because it means that the producer of zinc or the producer of lead does not change his production because the price of silver changes. And that's one of the reasons why silver tends to move higher, tends to move faster, both on the upside and the downside, because we don't get these changes in production. Now, we all know, of course, that even with gold, the changes in output happen slowly. They don't happen instantly. But still, there is a response from producers when the price of gold changes meaningfully. But again, there's no specific change to silver production when the price of silver changes. Obviously, if we go into a recession, then we start to get a change in the production of, let's say, zinc, and that affects the supply of silver. So I agree with, I'll just change the emphasis a little bit to make people happy, Lobo. I agree with you completely on what you say, but I would say that, maybe a year or maybe 2 years into the gold bull market, we could start to see silver outperform for a variety of reasons.
And let me add to what you're saying. There's a set of circumstances where if the recession is protracted, which I think is probably unlikely in this case, because I think the powers that be will open the free money floodgates and they will tromp on this recession as soon as it shows up, or try anyway. But if it was protracted, then you get into a situation where these lead, zinc, and copper miners start shutting down due to the recession. So that quashes silver supply willy-nilly at the same time where the fear sphincters are dumping adrenaline into investors' veins, and monetary demand goes up. And in the cases like post-2008 GFC and in 1980, you had these cases where there was, for different reasons, a squeeze on silver supply and high monetary demand, safe haven demand, which did spill over into silver, and silver went absolutely nuts. Both times it went to $50 was in circumstances like that. So if, this is not a prediction, I'm just saying, if we get this scenario where the recession really puts the kibosh on silver supply and fear makes silver and gold prices go up, then you could really see silver, triple digits is a possibility. How's that for a headline for you, Elijah?
But that re-emphasizes what we've both been saying, that in the shorter term, at the beginning of the cycle, gold is definitely what you need to emphasize. But perhaps later on in the cycle, silver could outperform.
I think the takeaway here is not the monetary theory or the metals theory, but how to speculate. Where we put our money, and I think that's what we're saying here is actually fantastic news for speculators now, because the stocks are unloved, right? I've heard Adrian give an excellent talk about this at New Orleans and other places, and he's got probably more of the facts and figures at his fingertips than I do. Wolves have claws anyway. But the stocks are unloved. Just the major indices, GDX, GDXJ, and priced in gold, they're scraping the bottom. And even on nominal terms, they're on sale. And the majors at least are getting a little bit of a bid, and the profitable producers. But the earlier stage stories, they are absolutely on sale. And I have, no question, there's an unbroken track record. If we go into a new bull market in gold and or silver, which I think we will, those stocks will not remain on sale. Those two things cannot be true at the same time, as long as human nature is what it is. So if we're right about gold heading substantially higher in 2024, the leverage to that your audience can get by picking quality gold and maybe later silver stocks too, I think is tremendous. So this is very good news for anybody who isn't all in already.
Let me just put Lobo mentioned how undervalued they are. Let me just put a couple of numbers on that, if I may. If you look at Agnico Eagle, third largest gold mining company in the world, it is selling in the lowest 10 percentile of its price to cash flow for the last 30 years, which is basically most of the company's history. But just think about that for a second. The lowest 10 percentile of its price to cash flow. When gold is at 1950 or 1960, as we talk, gold is not at 250 anymore. Multiples normally expand when the price goes up. Not only is gold at 1950, but I would argue that the profit margin, or the cash margins, let's say, are reasonably robust right now. I mean, if the average gold mining cash cost is 950 and all-in sustaining cost 1250 to 1300, gold is at 1960, you've got a fairly good margin there. Now, there's other things that go into that. We can talk about it later if you want, but that's just one example. Another example would be Barrick. Barrick is the second largest gold mining in the world. It is selling today at its lowest ever price to book value. I would argue that simply doesn't make sense. You can talk about Barrick and everything that's wrong with Barrick all you like, and the arguments about what's wrong with Barrick don't necessarily apply to Agnico Eagle, but you can talk about everything that's wrong. But then I ask you, should it be trading at its lowest ever price to book value? And I would argue no.
It is dramatic, the valuations we're seeing and how low gold mining stocks are right now. I did want to ask you both about kind of your philosophy between holding the physical metal and the mining stocks. I know, Lobo, you've talked about how the metal is money, right? If you're holding it in your hand, it's safe. It's a safe haven really for long-term wealth storage. But if you're looking to take advantage of the move in precious metals, the mining stocks often are better in that case. Your perspective?
Oh, absolutely. You framed it well. And I guess the short version is, when I was a wee lad sitting on Papa Casey's knee, and he was teaching me about the ways of evil speculation in the world, it was one of the lesson number one is we buy gold for prudence, is his word. And we speculate with the gold stocks. Completely different propositions, not the same thing at all. When you own gold, you hold it in your hand, right? There's no liability. There's no short against that. It's just pure wealth. Physical wealth can't be printed away, can't be inflated away. And there's no contract, there's no counterparty risk. It's just there. You sleep well at night knowing that you have physical, congealed energy, even if you want to think of it that way, wealth in your direct control. I sleep better at night. Maybe I'm psychologically weak or something, but I sleep better with that, just not under my pillow, of course. And the stocks, that's how we want to make money. If you're in the wealth preservation phase of your life, you might have a slightly different view. But if you're in the wealth generation phase of your life, then you want leverage. And maybe one caveat, one sort of halfway house in between is generally I'm not interested in the ETFs. If I want to own gold, I don't want a counterparty on my gold. That undoes half of the reason for having it. But if I'm convinced that a metal, gold or whatever, is going to go up, and I can trade that with an ETF, then that's easier than going down to the coin shop and paying the premium on fabrication for a bunch of beautiful buffaloes. And then I don't want to sell them because they went up, because they're beautiful buffaloes and I sleep better with them at night. Which, sorry, that's actually a benefit. That's a feature, not a bug. The fact that it's painful to sell these beautiful works of art that happen to hold wealth is good. It means you won't do it unless you really need to. You won't dip into those savings unless there's an emergency. You have no choice. Or an opportunity is so excellent that it makes sense to dip into savings to fund that opportunity. And that's how it should be. It shouldn't be, a willy-nilly thing where you're able to flip in and out. Then you'll make bad decisions. You'll dip into your savings when you shouldn't be.
Yeah, no, I absolutely agree. And again, the big difference is the purpose, the reason that you're buying. If you're buying for insurance, for security, for safety, you want to be as close to owning physical in your own grubby hands as you possibly can be. An ETF is to me an investment. It's not the same as holding the physical gold. And Lobo is absolutely right. The fact that it's difficult to sell physical, when I say difficult, it's more difficult, is actually a positive. Yeah. So I agree with everything you said.
Now, Adrian, I know if I could get then your perspective kind of going into the end of the year, your take on where we are and maybe when the best time would be to maybe dip it more into the junior gold stocks or the majors right now, especially considering tax loss selling.
Lobo and I may have a slightly different view on this. I don't know. I mean, I think that the senior miners and the senior royalty companies as well are where you should be emphasizing right now, because they are not only the first to move when gold takes off, but they're also the more certain to move. You know, I could name 5 stocks, you know, Kinross, Agnico, Barrick, Franco, whatever. And I can almost guarantee you that if gold goes to 2,500, I can, again, as close as anything in investment, I can almost guarantee you that those 5 will all be up. I could pick 5 juniors, Consolidated, Ajax, and Moose Pasture Incorporated, and they may or may not be up. So the seniors are the first to move, and they're the more certain to move. So at this point in the cycle, I think you want to be emphasizing that. Having said that, some of the juniors, and I always look for juniors, I'm sorry to jump around a bit, I always look for juniors that either have strong balance sheets or have some sort of income. And there are some revenue. Because if we head into a recession, it could be difficult for some of the juniors to raise meaningful amounts of money for a little period. So I emphasize the ones that have good balance sheets. Some of these are just remarkably undervalued. And probably over the next 4 weeks, you're going to see some astonishing buys because of tax loss selling. You can look at some of these juniors and they might do 20, 30, 50,000 shares. Well, here's Midland. It's done 15,000 shares today at 40 cents. You know, just do the math. That's not a lot of money. You need one person with $10,000 or $20,000 worth to say, I'm going to take a tax loss, and the stock goes down. It goes down, these juniors go down because one person says to his broker, sell my stock for a tax loss. And so we need to be in there with stink bids. We also need to be in there alert. When you see a stock go down 3, 4, 5 cents, you know, on a 40-cent stock, you need to be there to buy it.
I agree with that. I would add a couple of broader thoughts. I've already shared these with clients, so I'm not scooping any of my own people here. And that is, I think this year, where the whole sector share-wise is a downward slope, it's obvious that there's going to be a fair amount of tax loss selling. So I've already advised clients to sell early, to get ahead of that. You know, don't look for a higher price in December this year. You're unlikely to get it. With the caveat that if the war in the Middle East does blow out of its borders and spread, gold could, you know. But where we are now, you know, the trends that we're looking at now, and by the way, that despite a lot of hype and fear about that war, it has not spread. It is interesting how none of the neighbors have jumped in on Hamas's side. So that being now a plus 1 month trend, it seems, you know, it doesn't seem like a good bet that that's going to blow up and expand and engulf the whole region. So anyway, the trend for the year is down for gold stocks. Sentiment is still very bearish. With the war scare fading off, a lot of the stuff is rolling over as well. So I think we are going to see a lot of tax loss selling this year. It's going to be heavy. And therefore, you want to, if you are looking to do that yourself, you probably want to take that early. And I have heard from readers that they're taking me up on that. And then I've also said that, okay, there are a lot of bargains out there. But again, absent some kind of sudden change in the trends, as tax loss season deepens, we're going to see even better bargains. So you really want to build cash right now. You want to be ready to act, as Adrian is saying. I'm not sure a 10% move is enough, 3 or 4 cents on a 40-cent stock. I think, you know, we could easily be looking at 25, 30, 40% moves on some of these in you know, a couple of weeks when tax loss season really heats up. You know, say one of these funds starts facing redemptions because attitude goes negative. You remember Rab Capital 12 years ago, whatever, when they started liquidating wholesale, just everything got slaughtered. Made no difference the merits of the company or how strong the balance sheet was, or even that the drills were delivering the goods with every round of press release. They just sold indiscriminately. I'm not saying we're headed necessarily for quite such a bloodbath this year, but the setting looks like ripe for opportunity.
No, I agree. And let me just add one thing, which sort of Lobo, and I think I inferred it from what he was saying. But if I'm an investor and I think, oh, whatever, it's June, July, and I won't say Midland, I'll say whatever, Consolidated Ajax, and I say, you know what, this stock hasn't done too well. I think I'll sell it. I'll put in a limit of 40 cents, 41 cents. If I want to sell for tax loss, I sell. That's what most investors do. And my clients as well, when they call me for tax losses, they'll say to me, can you do it this week? Because I want to have 31 days in which I can buy it back. And Lobo's right. I think to wait for higher prices is a mistake. But the point I'm making is we don't even wait for higher prices. We just sell for tax losses. And if the mutual fund is getting redemptions, and I manage Peter Schiff's mutual fund, so I know what it's like. If you get a redemption and you have negative cash, you sell that day. You don't wait around and try to get a better price. Oh, let's sell 100,000 of this stock that I've got too much of and I don't like anymore, and you sell it. That has very sharp impact on the stock price.
Before we let you go, Lobo and Adrian, I did want to get your perspective. I know Lobo did mention the Middle East conflict and how, thank God, it is not, it seems like, expanding as a lot of people feared. But looking into the end of the year and the next year, how, I guess, Adrian, if we could get your take on this, how do you approach things like this? I know we saw, the war with Ukraine really have a short-term impact on the gold price. Are you expecting any more surprises or anything like that? And how does kind of the black swan, right, factor into your investment decisions?
Well, typically you can go back, 50 years, as I've done with some graphs, or slides. Typically, geopolitical events have very short-term effects on the price of gold. They tend to have a longer-term impact if gold is already in an up move. And also if the market generally thinks that the geopolitical event is going to worsen and deepen. But you go back 40 years, and whether it's 9/11 or whether it's the invasion of Iraq, these things tended to have a short-term effect on the price of gold. So not only from a sort of humanitarian point of view, I don't like to profit from other people's suffering, but I think it's a mistake, to think that gold will move up and sustain those moves because of geopolitical events. So clearly, I'm not a geopolitical strategist, but clearly if something were to happen, like, whatever, Syria downs a US aircraft or whatever, gold would move up, but it would probably be a short-term effect.
I agree. I'll just add the 2 cents would be, my perception is that, a war flare up or something like that, it always boosts gold. There's a knee-jerk reaction, very understandable human response, and silver too, by the way. But then if it doesn't keep getting bigger, then it fades. And then it reverts to trend. So like Adrian was saying, if gold's already on an uptrend, so it kind of tails into that. But if the trend was down before the scare, reverting to trend means it's going to head lower. And sorry, but the facts are gold was on a trend down before this flare up. So until the Fed breaks something or something else changes, as this war scare fades, maybe we see gold revert to trend. Now, I will say at this moment, the economic data we just were discussing earlier suggests that something may be changing. The Fed may be breaking something. And so maybe we don't go down to where we were. But where we were before was kissing 1800. So a reversion to trend here would be a pretty scary thing for a lot of gold bugs. And think about tax loss selling. The numbers I threw out earlier would be too weak, perhaps. But we've got, PCE coming, another CPI before the Fed's next meeting, another labor report. If these trends really are turning, as the last month's data suggests they might be, then we'd be not reverting to the old trend, but we'll be on a new trend.
And it will be very interesting to continue to track this with both of you, Adrian and Lobo. Thank you so much for joining us today on this panel. If we want to start with Lobo, where can people find you online? And did you have any last thoughts to add?
If you're a gold bug, if you believe in sound money, you're right, they're wrong. Don't listen to the talking heads. Don't get spooked out of this. Darkest before the dawn, all that sort of stuff. You are right. And have some courage. Have a garage sale if you're already all in. Sell some blood. Do whatever. Don't give away the kids, okay? But, raise some cash and screw up your courage and take advantage. I know people don't want to hear about another buying opportunity. They want payday. But we don't control that. And if the buying opportunity comes, you don't want to let it slip through your fingers because you're mad or, you're emotional about it. Sorry, I didn't say. Where can you find me? IndependentSpeculator.com. There's a free letter. I won't spam you if you sign up. Check it out.
Fantastic. And where can people find you, Adrian? And did you have any last thoughts for our viewers?
Yeah, AdrianDay.com is the best place to go. And then you can either click for my newsletter or click right for my money management, but AdrianDay.com. Yeah, I was going to say, not as eloquently as Lobo, but the same thing. The last thing you want to do is, give up right before the turn. And unfortunately, my experience, 40 years of money management, is when clients who went in overboard on gold, when they start calling me and saying, yeah, I've had enough, I just can't handle it anymore, that's probably a turn. And let's not forget, when gold stocks turn, they turn dramatically. So we're not talking about Nestle that might go up 10%. We're talking about, from 1976 to 1980, the gold stock index was up, eightfold. From 2000 to 2007, gold stocks quadrupled. From 2009 to 2011, they quintupled. Even in COVID, they doubled in 4 months. So it's worth holding on for those kind of returns.
Well, very good news. I guess for a lot of the people tracking the precious metal markets, it sounds like it'll be really interesting a time ahead going into 2024. Lobo and Adrian, we really appreciate your time today. Thank you so much, and God bless.
Thank you.
Thank you very much for asking us. Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.